I made $177,000 buying a car with infinite banking. I'm going to be reacting to this video that Devon Brrrr did on his YouTube channel. In full disclosure, Devon is a friend of mine. I watched this video. I shot him a text and said, hey, can I do a reaction to this? Because I have maybe a different way of saying things, and I have my own whiteboard that you'll see at the end of this, but I want to watch parts of the video and then give you my framework on how I think about infinite banking, buying a car, and he makes some bold statements in this video, and we'll see if those bold statements pass. Without further ado, let's jump in.
July 10th, 2025, and yesterday I just sold my Porsche 911, my 2021 Porsche 911, my favorite car I've ever owned. I just sold it. Here's the thing. I actually made $177,000 for owning, driving, and enjoying that car. How is that possible, right? Most people lose money buying cars. I made $177,000 by purchasing, driving, owning, and enjoying that Porsche 911. In this video today, I'm going to share with you exactly how I did it. You can see exactly how it works, and then you can go do the same thing. You can make money buying cars. I'm excited to share this.
All right, so I just want to say, remember some of the language that he says. He was very, very clear that he made $177,000 by enjoying and driving this car. One thing I want to just give Mr. Brrrr his flowers where he deserves is he loves cars, and the fact that he was able to use a strategy to buy a car that brought him happiness is something that at the end I will factor in because I think it's important. But again, this is the language that I'm going to be highlighting later.
With you guys, let's jump on in.
Let's jump in, brother.
So how did I make money buying the car? And it really comes down to the way I purchased the car. Most people that buy cars one of a few ways. They pay cash, they finance the car through a bank, or they lease the car. Now, when you lease a car, it's probably the worst thing you could do because you're just renting it. You're renting a vehicle. You'll never own the vehicle. Once that rent is over, you got to get another vehicle. Purchasing, you're borrowing money from the bank and paying them interest. So all of the money that you're paying is gone forever. You'll never get that money back, and you'll never get back what the money could have made you. It's called lost opportunity cost. Now, the other way is to pay cash, right? If you pay cash, you're not paying interest to somebody else, but you're losing the opportunity cost. So if you pay cash for a car, that money can never earn you money ever again in your entire life. So those are the three ways people buy cars usually. And when they do this, they lose money. Most people understand you're going to lose money buying a car. It's a depreciating asset. Here's the thing. I bought that 911 for $164,000 2 years ago. I sold it for $142,000. So most people would think, Devon, you are high. How does that compute?
By the way, that's a negative 13% rate of return, just for the math nerds out there.
You lost money, right? You bought it for $164,000, you sold it for $142,000. You see, I made $177,000 because of how I purchased it. I was the bank purchasing the vehicle. I practice infinite banking, becoming my own bank. And because I did it that way, I ended up making $177,000. I'm going to show you guys exactly.
All right, so then he goes over here. This is the whiteboard example of him sharing the math.
When you borrow from a policy, you have to treat your money just like you would treat the bank's money. If you bought a car, if you borrowed money from a bank, you would pay them on time every month without fail because you don't want the car to get repoed. When you pay them on time, you're paying them with interest. That's very, very important. If you borrow from a bank and pay them back with interest on time, you dang sure better pay yourself back, your bank, on time with interest. So here's how it works. I bought the car, and all I did is I figured out what the bank would have charged me, what the interest rate would have been, and what the payments would have been. And I simply took that amount and paid it back to my bank, back to my policy.
I just want to point out that this is a really awesome strategy in itself, and it's less of a strategy and just really good behavior. If you're going to buy things, especially liabilities, and you're going to either pay cash or use your life insurance policy or whatever, the idea is, hey, if you're going to pay a banker X, and let's say you could, pay cash. I'll just make this example: pay cash. Well, to be an honest banker, you're not just going to pay yourself back what you paid over a period of time, but you should actually pay yourself back with interest if you want to be an honest banker. And so some of this behavior we mix together with infinite banking, but really it's, if we separate it, Devon's going to be talking about his insurance policy, which is an amazing policy that's cranking, and then how he purchases that. They're really two separate things that a lot of people in our space mix together, and I can see where they mix it together, but I also think it can make things a little bit more complicated. So I just want to point that out as he's going through this.
So it's $194,000. That's how much I paid myself back for the car. That's how much I would have had to pay the bank if I would have.
So just to be clear, the loan would have been for $164,000, and then the $194,000 over those 2 years was the interest in addition that he paid himself or the insurance company, we'll see in this equation.
Bought the car and borrowed money from a bank, Chase, Wells Fargo, Bank of America, whoever it might be. All I'm simply doing is, instead of paying them, I'm keeping the money that I would have lost to them. Okay, it's going back into my policy where it's guaranteed to grow tax-free. It's protected from lawsuits and judgments. It's a better place for it to go. If it goes to them, it's gone forever. If it goes back to my policy, I can use it again. So I pay myself back $194,000. In 2 years' time, I put in $157,000 in additional premium. So you want to view premium as deposits. Deposits are how banks make money. The more deposits they have, the more they can lend. The more deposits I put into my policy, the bigger the cash value, the more I can use it. So if you add these two numbers up, over 2 years, I put a gross injection of capital, $351,000. That's how much I injected in capital into that policy. I also used $164 to buy the car. So if you look at my true net injection, I have a $187,000 net injection into that policy.
Later in the video, I'll talk about how my language would be a little bit different. I essentially would say the net injection was his premium payment, which is $157,000. That was what he paid in. The policy loan is an external activity, and yes, was there a little bit of overlap? Yes, but that would be a different way that I would explain it, and so you'll see later.
Very simple math, guys. 194 plus 157, that's 351. I used 164. So my net injection is 187. Very simple. Now remember, the cash value of the policy went from 172 to 394, right? That is a $222,000 growth. So think about that. I have a net injection of 187, yet it grew by 222. That's a $35,000 net gain on the policy, right? However, I just sold the vehicle. I sold the vehicle for $142,000, like I said to you guys. So at the beginning of this video, I told you I bought it for 164, sold it for 142. Most people would think I lost money. No,
He did.
guys. I have a net injection into the policy that I used to buy the vehicle of 187. It grew by 222. That's $35,000 in growth. And I have the 142 that I sold the vehicle for. So $142,000. That means that my true gain for buying that vehicle, $177,000. Guys, this is by far the best way to buy vehicles. And the longer you have a policy active, the more deposits are going to go in there, the more you're going to pay yourself back with interest. You're going to get more money in there to compound and grow. it's just the numbers are gonna be even more exaggerated. The next car that I buy, and I will make a video for that when I go to sell that car, but the next one I buy, I will make even more money on it, because that's just the power of compound growth. If you never interrupt it, it just keeps getting bigger and bigger and bigger. So guys, I hope you see that this is the best way to buy cars, hands down. There's not a person that's watching this that can tell me honestly, like, you know what, I've made that much buying a car before.
All right, so I'm gonna take your challenge, Devon, and I texted him that I'm gonna do this, and I would love to have like a part 2 where you come on and we chat, because at the end of the day, is your numbers wrong? No. Like at the end of the day, we might have different ways of getting there, and I'm gonna share my framework and logic, but again, I think it's beneficial for there to be multiple people out there sharing different things. I had Carlton Dennis on the show, and he talked about how sometimes he'll go on TikTok and talk about tax strategies, and some people will pick some of his stuff apart, and some of the times it's like, hey, I want to get the message out, and then obviously I'm not giving tax advice. And some of you, I've heard from you, you're like, hey, that's misleading, he should not do that. And then others are just like, no, I read or learned more about tax because I stumbled upon a Carlton Dennis video. I use that as an example because this is a version, when we talk about infinite banking, a lot of times there's marketing out there that can get people like exposed to this, but then it's like, is that the actual math, and is it how it actually works? And so the first thing I want to do before I share my screen is I want to take a step back, and I want to say, okay, a lot of times what we do is we mix internal in the account and external decisions. And so we'll say two things that I say, but I just want to acknowledge it, is first thing I will say is when I put money into the policy and the policy increases, like that's amazing. And so a lot of times we're looking at the growth of the policy, but really comparing it to that 1 year. I put in $1 and my policy grows by more than $1. When would I ever want to stop? Obviously, that's a good question to ask. And if you understand the power of life insurance, it's a good mental framework to be like, why would I ever want to stop once I have the power of life insurance and I'm putting in $1, I'm getting more back? But you could also say, well, you could do the same thing with a brokerage account. You could do the same thing with lots of different accounts. It's like I put $10,000 into my brokerage account, and let's say because I have a ton of money in there, it grows. I could say I put money in, but it grows by 300%, and I could make it look super amazing. And at the end of the day, you have to look at the actual rate of return, the internal rate of return, that you see the actual growth rate. The difference between life insurance and a brokerage account is there's guarantees built in versus there's less guarantees built in those things. So that's one of the reasons why we can say that. The other aspect that we can sometimes fall into is we can say, hey, like we can say, I used my policy to do X, Y, and Z, and I lump in the growth of the policy and the benefits of the policy with my external decision and lump them in together and say, like, I made $177,000 buying a car, when it was like, okay, if we really want to get legalistic, did you actually make money on the car, or were you going to be efficient regardless? And you just purchased a car that actually lost money, but because you had your policy over here, you're at the end, you're ahead. And that's what we'll break down, because the idea of saying you actually made money buying a car is where Mr. Brrrr and I will disagree. Everything else, from the philosophy, from the belief of life insurance, for how we just structure life insurance policies, all those is very much aligned. It's the statement, I made money buying a car, that I'm going to be pushing back. And so let me share my screen, and I'm going to do my best to just break down how I would explain this. And again, I would love to hear from you. Like, I'm sure there's going to be people that more resonate with Devon, and there's going to be some people that might resonate with this. All right, so the way that I will explain this is there is an internal and external deal here. Okay. External and internal. And I'm going to do a dotted line because I really do believe that these two things are different. So in a life insurance policy, money goes in via premiums, and they go in, and you're getting a life insurance policy that obviously gives your dollars more than one job. If you've seen any of my videos, you know that when structured and used properly, you're putting money in, you're getting protection, you're getting growth, you're getting creditor protection, you're getting all these things. And at the end of the day, you're getting anywhere from 3 to 5% growth in the policy, plus you're getting the other benefits. And so it's a powerful asset. And obviously, if this is the first video that you're watching of mine, got a lot of other videos that explain why life insurance and all. And if you have any more questions, we have resources, and you can even talk to someone on our team if you have more questions about how that works. But at the end of the day, lots of benefits of life insurance. That's not the purpose of this video, but you're getting benefits. And so even Devon talked about over two years, he put in $157,000 into his policy. That's a policy contribution. Those are policy premiums, and that's going to be relevant a little bit later. Okay, so a part of the benefit of life insurance is you have access to capital. So when you get money, and we'll just say, to make math easy, let's say you have $500,000 of cash value over time in your policy. You can have access to that. Now, you can withdraw that money, but if you withdraw that money, you can't get that back. And so a very common way to access this money is actually through a policy loan, which, think of it as like a HELOC that's attached into your policy. And so you could take a loan against your life insurance policy, and your capital and all is still doing its thing, but then you have access to that money. And so we're going to call this, I call this the control cost. But at the end of the day, it is a policy loan that you can access. And I want to just point this out. Just like if you were to buy a home, and I bought $1 million home, and I was to get a home equity line in there, my house is going to be, let's say it's $1 million home, and I get a home equity. Does my home's value change at all? Does the market value change? The answer is no. Does the home equity change the value of the market of my house value that someone would be willing to pay? No, but the home equity is another feature that I have. And then so similar to this, it doesn't, by having access against your capital, it doesn't necessarily affect the value of the policy. It just gives you access to capital. And so you have control cost. In this scenario, just to make this simple, let's say the control cost is 5%. I'm using 5% because that's actually the scenario that Devon was in. It was 5% control cost, but this could be higher, it could be lower. So what this is essentially saying is it cost 5% in this scenario to take a loan against my policy. Now, when you make a purchase, and I'm not going to use a car for example, I'm going to use just basic examples. Let's say I have something that I could put my money that earns 0%, and let's say I have someone I could put my money that earns 12%. Okay, not investment advice, but just two places I could put my money. So I put my money into a life insurance policy, gets all the benefits of insurance, not arguing that. And then I decide, you know what? I am going to take a loan against my life insurance policy. And so negative number one in deciding that is if I take a loan, let's say I'm going to take a $100,000 loan. Now I'm using up some of my availability, and now I only have $400,000. Okay. So I have $100,000 that I can't now utilize immediately because now I'm deciding to use that money. And I am paying 5% a year for that. And I can make one of two decisions in this scenario. I could put my money in 0%. And in that scenario, I know this might sound crazy, but it's like I'm paying 5% to earn 0. That's a negative 100% on my money. I'm paying $5 and making 0. That's not a great equation if I'm looking at this from an investment standpoint. Or I could use that money, put it into a 12% return. I'm paying 5% to earn 12%. That's actually 140% return on my money. Okay, so the difference there is I could spend 5 to make 0 or spend 5 to make 12. And those are the two examples. And I think we would look at this and say, okay, yeah, I think it wouldn't necessarily be a great scenario if I took 5% to make 0. Yes, my policy is still growing, but you could make a point that you are actually worse off. The reason you're worse off is you're paying 5% to earn 0, and now you have $100,000 of less liquidity to be able to use. Yes, your policy's still earning, your death benefits, like you're getting all the benefits, but you could also say like, I'm getting those benefits regardless of whether I use my money or not. That's why for me, internal and external are two separate conversations, because internal is going to happen regardless. External is an additional thing that could be beneficial or it could be negative depending on how I use it. Now, the other scenario, let's say I take this and now I put it in 12%. Now I'm making money over here. So external, I'm making a good chunk of money. So I'm making money over here, and I'm also getting all the internal benefits of life insurance. So you could see where it's like that life insurance policy is giving me all the benefits, and it's giving me an opportunity to make money. And that's where you could say like that's the power of having access, using your dollars more in one place. That's why I think entrepreneurs and investors love this strategy. And so again, I don't necessarily want to beat a dead horse here, but that is very much how I would view this. Now, the interest that you would pay back in this scenario, 5% doesn't go to your policy. It actually goes to the insurance company, but we can say that it's kind of all connected because, it's allowing your money to grow. And even though in a lot of cases you're paying a higher interest rate than what you're earning, your life insurance policy is getting you a greater result, greater benefits than what it's costing you. So it's actually still efficient if you want to use capital to take a loan versus withdrawing that money. All right, so when we go to the Mr. Brrrr scenario, I have no problem with his policy here. His policy is cranking. He's putting $157,000 over 2 years into his policy. His policy's cranking. It's doing its thing. I think he said he made an additional, like, over 2 years, he has $35,000 of money, like, of growth. And so that's super cool. And he's got a limited, I mean, he's got a lot of money in there, but he's only has so much liquidity. Okay. So he's got his cash value here. And it ranges, but he's got cash value, and he's got his third party, or actually his insurance company, third party, which is insurance company in this scenario, at 5%. And he loves cars. Like, that's something that he absolutely loves. And so he's getting a car over here, and he's saying, hey, I want to buy this car. It's going to be $164,000. Okay. It's going to be $164,000. And I could go get a bank loan, and the bank loan would be 7%. And so I'm going to use my policy's built-in loan feature to get something at 5%. And I'm going to take $164,000 out of my cash value availability, which will become relevant soon. So I'm taking that out. So it's not out, but I have $164,000 less of availability to use if I wanted. And I am taking that, I'm buying the car, and then over time, Mr. Brrrr over here, am going to be paying back 5% there, an additional 2% to the policy. So 2% is going to the policy, 5% is going back to the insurance company. This by the way, is an awesome behavior, but I want to acknowledge that whether you're using a savings account, whether you're using a brokerage account, whether you're using anytime you end up paying extra, you're going to get a benefit, but there's no magic bullet there. It's just good behavior. It's just like, it's good. If everyone did that, we'd be better off, but there's nothing magical about this. It's just, you're saving more money, which is awesome. So this is great, but this 2% plus this $157,000 equals the additional $35,000 of greater cash value over those 2 years. So just acknowledging how we got to that number. Okay, so then year 2 goes by, or 2 years later, and Mr. Brrrr ends up selling this for $142,000 and ends up on paper losing $22,000. But let's just be real. He costs $22,000 to enjoy an amazing car. like an amazing car, amazing memories. And so that's where I'll even go back to like, is leasing a waste of money? It depends. Like in this scenario, would it cost more than $22,000 to lease this car kind of deal? And if the answer is yes, then I would say actually leasing the car would have been a better decision. You know what I'm saying? If it, let's just say, I'm not saying it, I'm not a car person. Let's just say it costs $10,000 a year to lease that car, and you got the same amount of enjoyment and all, that would actually be $2,000 better to lease. Now, that's crazy because you're not necessarily going to get that scenario. But at the end of the day, the true cost of driving that car over time from a car standpoint was $22,000. And then obviously there was interest cost, that extra 5% of interest that was also tacked on to that. And so that would have to be factored in. And so overall, that's something that needs to be aware, but you're going to have that expense regardless. So then the question is, should you have bought that car? And, you know, that's where everyone's consumption decisions could change. But back to the point here. So the idea is there's an internal value and then there's an external decision. And the reality is that it's not wrong. If you add this number back plus this number, you get, you know, 177,000. But if I'm playing devil's advocate, someone could be putting their money in the investments and take a, let's just say this. I'm gonna be crazy here. Let's say you're putting money into an account and it's less secure and all, but it's growing. And let's just say, again, I'm not saying that this is going to be the case, but let's say it's growing at 8%. Okay. And then you take a bank loan, and instead of 5%, it's 7%. Okay. You take a bank loan, you get that same car, bank loan, instead of having 2% go back to you, you're paying the whole 7% back. Your $157,000 is going into this account and more, earning that rate of return. I bet you if you broke down that math, this on paper would actually outperform the scenario that Mr. Brrrr shared. That's just, and I'm not endorsing that strategy. I'm just saying, like, from a perspective standpoint, that would be something to look at. And we could say, well, I'm not paying myself back at all. Well, we have to remember that Mr. Brrrr took $164,000 against his account over here. And so if you just took the exact same thing from the bank, you would have an additional $64,000 that would be earning for you or available to be able to use. Hey guys, I just wanted to interrupt real quick. If you're watching this and have an index universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track. I want to know if this is set up properly. We at BetterWealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode. All right, so let's land the plane here. So when I'm making a decision, I'm number one, if I'm making a decision about a car or anything, the first question is, should I buy that? So should you buy that? Lots of different ways to come to that conclusion, but at the end of the day, should you make that decision? And that's a whole nother video in itself. So let's say Devon is going to buy this next car and he's just set, and let's just say I know nothing about cars, but let's say this car is going to cost $200,000. So he's gonna make that purchase. That's what's gonna be. Then the second deal is, how should you purchase that? Now, Devon made a big, bold statement. He said that there's no better way to purchase this vehicle. And I'm not even going to compare to other investments. I'm just going to keep it in the infinite banking family. But what I would say, and what I would actually do as a fan of life insurance, is I would actually not use my policy still buy that car, and I still think you'd be better off. And let me see if I can convince you. And we'll I can't wait to do like part 2 with Devon to see his thoughts on this whole thing. But I am going to be funding money into my policy, and my policy is going to be doing its thing regardless. The internal value does not change. It's going to continue to grow every single year. Benefits of life insurance, blah, 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 blah. And let's say for this example, I have $1 million worth of cash value. The reason I share that is I think Devon's close to having that much cash value available. Amazing. Okay. Now, so that's internal. Now I'm going to buy a car over here, and let's say I'm going to buy a $200,000 car. Okay. So here's the deal. I could give up some liquidity in my policy, and let's say I can get a 5% loan. So this would be a 5% control cost. And let's say this car, I'll just give the huge benefit of the doubt and say that it's just going to be a 0%. So I would say like you could sell it for the same amount in a couple of years. We're just going to do a wash. Even though I would even say most people would say that's generous. That's not going to happen. But we'll just say that's going to happen. So 5% control costs to buy an activity that ultimately is going to result in nothing. So at the end of the day, this is going to cost me 5%. Now, the 5% is not necessarily the issue, because if I didn't have any other opportunities over here and my money was just sitting, 5% actually may be the most efficient, because banks, at the time of this recording, banks could be at 7% or more for a car loan. So if I didn't have any use for that money and I was, I just didn't care, then 5% is the most efficient way to go about that. And that's none. Now, if a bank could give me 3%, I think everyone would agree that, yeah, the banks, like, choose the bank and then take the extra percent and pay yourself. And so I think, like, if banks were cheaper, I think that's one argument. But if banks are more, then Caleb, why am I still not going to use my policy? And it really comes down, not that this is going to be a negative result, because we've already decided that the car is going to be purchased regardless. So I'm not trying to convince anyone not to purchase the car. What I'm more merely saying is I would rather keep my money over here available to use for an opportunity that was greater than a 0%, ideally greater than 5% or 7% or 12%. So a mistake that I see some people making in the infinite banking space is they fund money and then they buy things that they could get loans for elsewhere. And what they do is they might even get a good interest rate, but they're giving up liquidity, and that liquidity has an opportunity cost associated to it. Ultimately, you're giving up less control to be able to say yes to something, and as a result, you are tying up your money for a conversation that ultimately is not going to be heavily asset producing. Now, does having a nice car, does it create other opportunities and all that stuff? Potentially, but you get what I'm saying. It's the opportunity cost of being able to say yes to something. So this, I don't even go as far as to say I wouldn't take a policy loan to earn 7%, because why would I tie up money to earn 7% when I could potentially earn greater than that? Does that mean that I may go some years with not earning 7 when I could have and I learned less? Yes. But that also just gives me the ability to have the ability to say yes in a powerful way. And so the idea is, regardless if I buy a car, whether I buy a 7% investment or all, I can say my policy and that activity combined together is a great activity. But again, at the end of the day, I think what we need to do is we need to separate these things and see behavior as one thing, the external decision as another thing, and then the internal benefit as the following thing. Again, I know that there's probably lots of different ways that this video could be made, that could be communicated. In summary, I love the Mr. Brrrs out there that are bringing exposure to the strategy. Is his math wrong? No, but did he position the situation in a different way than I would? Yes. I shared how I would go about it. I look at internal values, external decisions, and I separate them. And I think the moral of the story is life insurance gives you lots of options. If you want to use your policy to go buy cars. And even though your car might lose value over time, your policy is going to be efficient. And over time, if that makes you feel good, awesome. You're still better off than most people. But I don't think you can say that this is the most efficient way to purchase, because I just showed you by retaining some of your capital, potentially being able to deploy it elsewhere. Or if a bank was a cheaper money, you could do the exact same thing and redirect money more to you. There was in the past, when mortgage rates were super low, there were some people that were using their policy loan to pay off their 3% or 4% mortgages, and they would actually pay a higher interest rate to the insurance company to refinance their mortgage at that was cheaper. And from a mathematical standpoint, I would scratch my head, because I'm like, you're giving up liquidity and you're paying more interest, and you're actually not paying more interest to yourself. You're paying more interest to the insurance company. And I didn't necessarily look at that scenario as a smart financial decision, but for some people, it was very motivating. It was the thing that made them want to save. It was the thing that got them excited about this whole deal. And so that's where you have to really be careful with the whole math equation and not lead super strong with math, because math can be one thing, but we know that we're not where we are in life because we look at spreadsheets for everything. And so I could tell you firsthand that the message of using your policy to buy cars has motivated and excited a lot of people to save more, drive their dream car, but know like, hey, I'm driving my dream car, but I'm also saving hundreds of thousands of dollars a year into life insurance. And so there's that aspect. Whereas a lot of people are spending the difference. They're not recapturing their interest in any way, and so they're less off. Worse off. So I know this was a long video. I look forward to hearing your thoughts. I look forward to bringing on Devon to share his counter, and maybe us run some more numbers together. And again, I want to thank you as the viewer for making this journey possible. I couldn't imagine I just couldn't imagine in starting this channel that I would be able to make videos and get people's perspectives and hear different feedback. And so thank you for making this possible. If there's anything that I can do, our team can do in helping you review your policies, maybe you want to talk about a strategy like this and talk about what this would potentially look like for the future if you setting up a life insurance policy, we'd love to help you. You can check out the link below and subscribe for future videos.